when we sign a mortgage contract, we are told many things which we don't pay attention to, but they make a big difference in future in case our financial situation changes. Here are the things you must know if you are a mortgage holder or going to be a mortgage holder for your new house. First thing is rates. The best mortgage interest rates are going to be offered to you by big banks. This is the bottom line. Any other lender, B lender, C lender, credit unions, private lenders, all of them, they are marketing to lure the potential customers in. You see on advertisements and on websites interest rates by small lenders lower than the big bank interest rates. They are all misleading rates. Those are the rates offered to the specific borrowers. For example, borrowers who can bring in 35% down payment or 50% down payment. If you have that kind of money for down payment, go to the bank. They will offer you even better rates than whatever a B lender or C lender is offering. It is very simple. It's all business here. No one is offering anyone free lunch. Banks have certain criteria for mortgage of the house. If you do not qualify on that, you go to the B lender or C lender that have lax qualification criteria. And therefore, they charge higher interests or fees. You can only get the best deal from these big banks, namely RBC, TD, BMO, CIBC, Bank of Nova Scotia, and National Bank. These banks, they have a lot of resources which makes them able to offer good rates. If a mortgage broker tells you otherwise, just remember that these mortgage brokers are marketing one lender or the other, or marketing one lender over another, whatever the case may be. If you are in very good financial position, do not fall for one of these marketing gimmicks and try to get mortgage from one of these big banks before you go to B lender or C lenders. When you are getting your mortgage, you have to choose between fixed rate of interest or variable rate of interest. Fixed rate does not change. They give you fixed payments every month. It gives you peace of mind also. Variable rate of interest changes along with the Bank of Canada's interest rate. The bank increases the interest rate, you pay more. The bank decreases the interest rate, you pay less. Usually the variable rate is lower than fixed rate. Present times are exception because Bank of Canada is reducing interest rate fast and fixed rates have not caught up yet. So the variable rates are higher than fixed rates. How it works is that when Bank of Canada changes the rate, all the banks change their prime rate, and variable rates are based on prime rates. The fixed rate is based on 10-year bond yield. When the Bank of Canada increases its interest rate, 10-year bond holders start selling the bond. The price of the bond decreases and the yield goes up. The Bank of Canada started raising interest rate on 2nd March 2022 when the yield was 1.995% and kept raising it until 13th of July 2023 when the yield was up to 3.363%. When the banks start decreasing the interest rate, the 10-year bond issuers start recalling or retiring the bonds to take benefit of lower interest rate and the yield goes down. Now selling the bond and retiring the bond takes some time, but in a nutshell, Bank of Canada increases interest rate, increases the fixed mortgage interest rate, and Bank of Canada decreasing interest rate decreases the fixed mortgage interest rate. Next is insured mortgage, uninsured mortgage, and insurable mortgage. What are these? Insured mortgage is also called high ratio mortgage. The down payment is less than 20%. There needs to be a default mortgage insurance offered by one of these insurance companies currently, Canada Housing and Mortgage Corporation, Sagen, or Canada Guarantee. There's a benefit of lower interest rate on insured mortgages. Uninsured mortgage is with the down payment of at least 20% of the total mortgage. The interest rate offered is higher on these mortgages. Currently, the difference is hovering around 0.4% to 1% above insured mortgage rates. Do your calculation on your mortgage. This percentage make a big difference on your monthly mortgage payments. Insurable mortgages. Now you need to be very careful about this kind of mortgage while applying to the lender. This mortgage has minimum 20% down payment. The lender has an option to insure the mortgage for which they pay some cost on their own. Sometimes they try to pass on this cost to the borrower. So confirm with your lender if they are getting insurance on your mortgage and find out the cheaper way to get the mortgage. Don't be fooled. You are paying 20% down payment on your mortgage. You don't need any mortgage default insurance. There are two types of mortgage payments: accelerated payments and unaccelerated payments. Accelerated payments are on weekly basis or bi-weekly basis. They are more frequent. Unaccelerated payments are on monthly basis usually. There is some saving on accelerated payments compared to unaccelerated payments. Choose the one that suits you best. The amortization period. Amortization word comes from Latin word mort, which means death. So amortization period of the mortgage is the time it takes to pay it off in full. It could be 25 years or 30 years. What is loan to value ratio? It is a percentage of mortgage amount to the value of the property. If it is lower, you will get lower interest rate. If it is higher, you will get higher interest rate. How much does the credit score matter? 680 is a good credit score. That is all you need to know, and to qualify for a mortgage, you have to have lower or no debt at all. This is the best scenario because I have seen people who have more debt than they can handle even if their credit score is above 700. They do not qualify for mortgage. Two very important things to consider while getting a mortgage. Number one, check if you have an option of prepayment. Can you pay your mortgage fully or partially before your mortgage term ends? Number two, what is the cost of breaking your contract? When you want to break your contract and go to some other lender or refinance it, there is a cost to pay. Check the cost. Because this happens, as it is happening with a lot of people right now. The people who had their mortgage signed early last year when the rate was very high, they are breaking their contracts and paying the fees, refinancing it with another lender because it is saving them $10,000 to $15,000 in long run of the life of the mortgage in mortgage interest payments. The mortgage interest rates are coming down and they are going to keep coming down in near future. Next thing to know is collateral charge mortgage. A lot of banks and big banks offer only this type of mortgage by default. When you specifically ask them for just regular mortgage, they give you what you need. Otherwise, they sell you collateral charge mortgage, which has a restriction of switching your mortgage to other bank at renewal or before that. Now, the government has facilitated people by removing the stress test and they can switch and get lower interest rates way more easily. But the people who are in collateral charge mortgage cannot switch. This collateral charge mortgage is also called re-advanceable mortgage, in which mortgage and line of credit are bundled together. There is a restriction of switching to other lender, getting home equity, line of credit, and creating second mortgage or third mortgage. Regular mortgage is registered for up to the value of the mortgage, but collateral charge mortgage is registered for more than the value of the mortgage. Let's say 125% of the mortgage amount. For example, your mortgage amount is $500,000 and the mortgage is registered for $625,000. These practices exist because people do not argue with the bank in a hope to just get the mortgage quickly. Most of the time, only way to get rid of this kind of mortgage is to just pay off that mortgage. Otherwise, it would be costly because you will have to hire a lawyer who is going to charge you a fee. And the banks are going to charge you additional fees too. So I hope you understand these concepts and work actively with your bank, your lender or mortgage broker and ask probing questions and get the mortgage terms that suit you best. I wish you luck. Thanks for watching. See you in the next video.